Hey everyone. Although most economists believe a soft landing is the most likely outlook for the US economy, we still face a lot of questions about whether US consumers have the wherewithal to sustain their spending. And consumption drives about 2/3 of the US economy. If people's finances weaken, it could weigh on growth. One of the things that could restrain consumers is elevated debt. If people get too far out over their skis by borrowing too much money, the economy could hit a wall. And that's one of the things I see in the media all the time. As of the second quarter, total household debt was at a record high $17.8 trillion. That's a big number, but we have to break it down a little bit. Of that total, 72% or $12.9 trillion is housing debt, basically mortgages and home equity lines of credit. And most of that debt is at a very low interest rate, and most people have a fair amount of equity in their homes, which implies that housing debt probably won't be a problem. Then there's the $4.9 trillion of non-housing debt. That includes about $1.6 trillion of auto loans and $1.6 trillion of student loans, and it also includes credit card debt, which is also at a record high $1.3 trillion as of August. And that sounds like dire news, but there are two sides of this story. First, we have to consider that the total number of jobs in the United States is at an all-time high. As of September, there were more than 159 million jobs in the US. That's 2.4 million more jobs than there were a year ago, and 7.7 million more jobs than there were 5 years ago in 2019 before the pandemic. And at the same time, wages have been growing more quickly than inflation. The 3-month average median hourly wage growth as of September was 4.7%, while the headline CPI inflation number for the same month was 2.4%. So while the headlines continue to reiterate how debt has surged, they don't mention that job creation and earnings have kept pace. And if you look at household debt service payments as a percentage of disposable income, it's just 11.5%. Now, that is higher than it was a year ago or 2 years ago. In fact, it's the highest level since the onset of the pandemic. But remember, it was hard to spend money when everyone was locked in their houses during the pandemic and a lot of stimulus checks were sent out. So just like when I benchmark commercial real estate transaction velocity, I don't compare metrics like debt service to the peaks and valleys of the last 4 years, the pandemic era. I compare it to 2014 through 2019, what I call the normal times. The time following the recovery from the global financial crisis, but before the onset of the pandemic. And during that span, the average household debt service payment as a percentage of disposable income was pretty steady, around 11.7%, just slightly above where we are now. So is the consumer really under severe pressure? Is the mounting pile of debt a real problem? I suspect it is for some households. I think there's a bit of a bifurcation here, and that the lowest income households do face disproportionate debt and economic headwinds. And that's showing up in elevated credit card, consumer finance, and auto loan delinquency rates. But even still, the credit delinquency rates are well below where they were during the global financial crisis. So while some households face substantial economic pressure, most people are in a relatively strong financial position. And as a result, consumption will likely remain healthy. And that's good news for commercial real estate. Sustained consumption will not only support the economy as a whole, but it will bolster retail space demand. And as a byproduct, demand for industrial space will remain sound. And the strength of the employment market and wage growth will continue to invigorate household formation, growing demand for both rental housing and self-storage space. In addition, strong household balance sheets tend to support leisure travel, strengthening demand for hotel rooms. So, while we continue to hear about economic risks like rising debt levels and delinquency rates, many of the most important indicators remain positive. So as always, dig under the surface. and keep your eyes on the horizon.